Hi everyone, and welcome back to Lendy's monthly financial and property update this month. We are in October. In today's video, we'll be discussing the latest trends, changes to the loan serviceability expectations announced by APRA, and the impact of lockdown easing on the Aussie property market. Today, and welcome back David Hyman, our co-founder and CEO of the Lendy Group. So welcome back, Dave.
Thanks, Steve. Great to be here.
Awesome. Well, as always, let's just dive right in. Can you give us an overview of how the property market is currently performing, given that we're all starting to ease out of those lockdowns?
Yeah, absolutely. Look, as we anticipated last month, we've seen continued strength in the property market. We've obviously seen Sydney and more recently Melbourne start to ease out of our respective lockdowns, and that's flowed through to both pricing, volume, and also the clearance rates. So if I start really just in terms of pricing and values, across the month of September, and this is CoreLogic data, we saw national home value prices rise another 1.5% in the month. So obviously an annualized rate of over 18%. And actually, as a bit of a sidebar, I saw that Westpac's chief economist yesterday actually revised their national growth forecast over the year to now 22% nationally, which is just huge. So that's property prices doubling less than every 5 years, and we've obviously seen significantly sharp rises over the last 12 months. And on that, so if we look at the first 9 months of 2021, we're actually up 17.6%, which is over 20% higher than the past 12 months, and it's the biggest annual boom since 1989. So for some of our viewers, the strongest prices in their lifetime. And we've also seen in that process a rise in guarantor loans. So this is where typically first home buyers will use a parent or a family member to guarantee the loan. And that's really driven by the worsening affordability driven by the prices. So obviously as prices rise, you need more of a deposit, you need more income to service those loans. We expect those growth conditions to remain positive, but it is pretty clear that we've moved past that peak growth rate in March where we saw monthly price rises of like 2.8%, which is a huge number. There's going to be some of the things to think about in terms of what might slow things down is kind of higher barriers to entry for non-homeowners and fewer government incentives. So we've obviously seen house prices rise faster than income. So income growth has been stagnated, but we've obviously seen Sydney's median house price, as an example, is more than 1.3 million at the moment. And that's obviously flowed through to first home buyers through that affordability. We saw a drop of about 20% between January and July. However, there's an interesting trend forming where we're seeing more first home buyers actually rent first. So this is where you buy a property to get on the property market, and maybe let's say you can only afford $1 million. You might buy, say, in a regional area, and then you'll rent in the city that you want to live in. That gets you into the property market, allows you to get those capital gains without obviously having to sort of make the jump and maybe buy a place for $1.5 or $2 million depending on where you're living. And we've seen those types of first home buyer investment loans actually increase by 45%, which is just shows the strength behind that part of the market.
Thanks, Dave. That's super interesting. With the rise in home buying, we had some news recently from APRA, who made some changes to banks' loan serviceability expectations in their view to combat risky lending. Can you maybe explain to our viewers why these changes were made, and maybe in your opinion, what impact this might have on the industry as a whole, but maybe those watching out there as well looking to purchase their next or first home?
Yeah, absolutely. So I guess in layman's terms, there's a number of regulators. So APRA is one of them. They regulate mostly the banks. There's also ASIC, the Australian Securities and Investment Committee, the RBA, the Reserve Bank of Australia, and Treasury is also involved in a group called the Council of Financial Regulators. And they're effectively charged with looking at the health of the economy from their various vantage points and deciding on measures that might make sense to ensure the stability of the financial system. So that might be raising interest rates, or in this case, what they call macroprudential measures. And to break that down in terms of what it actually means is because prices are rising so high, and that's predominantly driven by this very, very low interest rates we've got at the moment, there needs to be something done at a government level, either fiscal policy or monetary policy driven by the RBA or APRA to slow that price rises down, because it's obviously not a sustainable thing in the economy. Now, one of those things you could do is you could raise interest rates, but given the amount of debt that's been taken on by not only the federal government but households over the last 12 to 18 months in particular, and the current level of inflation, we don't expect interest rates to rise for some time. And so they need to look at some other levers. And so what APRA proposed is to increase what's called the buffer rate. And so let's say you're getting a mortgage today and that mortgage might be priced at say 2.5%. In the past, the banks would use a buffer rate of 2.5%, incidentally, to work out could you afford that loan should interest rates rise. APRA has now changed that buffer rate to 3%. And so what that ultimately means for people looking to get into a mortgage is, depending on the pricing segment that you fit in, so whether you're an owner occupier with a low loan to value ratio, or whether you're an investor paying interest only, and your actual mortgage rate will impact you differently. But ultimately what it means is for some of those segments in the market, we'll see their borrowing power reduce. Now, we don't expect this to be a significant reduction. Some estimates have been somewhere between 3 and 5%, depending on the segment that you're in. And this is really there to sort of start to put some of the handbrakes on that sort of runaway price growth driven by the low interest rates. There have been some comments from the regulators that this might be the first of a few moves, and so the whole industry is kind of watching this reasonably closely. But all in all, this is a good move in terms of creating some more stability both in prices and the overall economy.
That's really interesting, Dave. Thanks for that. Just a question, probably a personal question, but one I'm sure our viewers will also be asking. If I am looking at the market and a potential purchase coming up, what should I do now to prepare given those changes, if anything?
Yeah, so as I said, it won't impact all segments. And if you're at the pointier end of the market, there's what's called a floor rate, which is the minimum rate that a lender can assess you at. And depending on the lender, that's going to be somewhere between 5 and 5.5%. But as with anything, our recommendation is always to speak to a mortgage broker. They'll be able to guide you through this process and work through, will this impact you? If so, what does that mean for your ultimate borrowing power?
And while we're on the subject of purchasing, in our last monthly update, you mentioned that we might expect to see some housing markets bouncing back now restrictions are starting to lift. Certainly in New South Wales, there's a bit of an air of normality starting to encroach, and Victoria and all our friends in Victoria, that's starting to see the same thing as we all come out of lockdown. Can you share maybe some insights with us on whether we're starting to see any positive trends, and is now the time to jump right in?
Yeah, absolutely. Look, we have, as I said at the beginning, we have seen significant strength. So if I start with stock, or the number of properties on the market, and there's obviously a number of different measures for this, but one of those is how many homes are taken to auction in a given week. And we saw just over 2,700 properties taken to auction last week across the combined capital cities. This is the busiest week since mid-July. And when we compare this to the same week last year, it is significantly higher, not just sort of marginally. It's thousands higher than last year. The second measure of strength is clearance rate, and so how many of those properties that are taken to market ultimately sell. And we've actually seen each capital city recording a clearance rate well above 80%. In fact, Sydney was over 90% last week. If we're sort of talking to strength, you don't really see numbers stronger than these. And then I guess zooming in on a couple of markets in particular, obviously Sydney's auction volumes have been trending up, but the lockdown in Sydney was far less hard than Melbourne, so to speak. And in Melbourne, we saw, the impact we saw through the lockdown period was what we call auction withdrawals. So these peaked at around 61%. So this is properties taken to market that are then withdrawn because they're not ready to sell. And that was largely driven by the fact that open homes were prohibited through most of Melbourne's lockdown, whereas Sydney you were able to continue. The good news for those in Melbourne, either looking to sell or those looking to buy, and you want to get into the place before you buy it, is we've now seen that trend reverse, and that withdrawal rate dropped down to 7% last week. And the clearance rate was actually above 80%. So that means the properties that are on the market are selling. And obviously based on the latest restrictions, you can actually go and view those properties in person. So that's all the things that you need to sort of, support a functioning and healthy property market. So to sum it all up, Zara, it's very, very strong out there. For those of you looking to buy, there's, very, very compelling reasons to do so soon. We expect price rises to continue, albeit they should taper off from the sort of 20% plus levels. But again, it can be quite expensive staying out of the market. So make sure you time things properly. If you're a first home buyer, it may seem expensive, but to the extent you can afford it, there are plenty of people that have taken the leap, and to the extent you're selling and then buying, you can consider things like bridging loans, etc., to avoid being left out of the market in the middle.
Thanks, Dave. It's exciting that there's more positive than there is negative news in the market at the moment. And as I said, I think a little breath of normality is starting to appear. If you want a little bit more help on that borrowing power piece, certainly with those new APRA changes, again, do speak to one of our specialists. Log on to lendy.com.au, book an appointment, and it's all free. We look forward to seeing you at our next update. Thanks so much for joining us, Dave, and thanks for watching.